The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program set up in 2003 and is currently overseen by Monetary Authority of Singapore, MAS, and Ministry of Manpower, MOM. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Fundamentals of Share Investing. This is the first of 2 videos on the fundamentals of share investing. In this video, we will look at the pros and cons of share investing, what you need to know before investing, and strategies when investing in shares. Pros and cons of share investing. The pros of investing in shares are that shareholders are able to participate in the growth prospects of the companies that they're invested in and the future earnings potential of those companies. Get to receive dividends if declared by the companies. Have the right to attend and vote at annual or extraordinary general meetings. Have limited liability. May be able to earn returns that beat inflation. The cons of share investing are that shareholders rank behind all other creditors if the company has to be liquidated. Will have to deal with fluctuations in their share prices. May see their shares suspended either by the companies or regulators, in which case they may not be able to liquidate their investments. Will suffer magnified losses if they undertook leveraged trading. That is, they borrowed to buy the shares. Why do companies list? Companies list via initial public offers or IPOs, mainly in order to raise capital for business expansion and to pay off debts, enable major shareholders and private investors to cash out. Why do companies voluntarily delist? In recent years, there have been an increasing number of companies which have given up their public listing status in order to become private companies. The reasons for doing this are: their shares are not actively traded. They believe that the market persistently undervalues their shares. They have enough funds and have no need to raise additional capital. The cost of remaining listed, such as listing and directors' fees, outweighs the benefits. Managements want greater flexibility to run their businesses without having to answer to shareholders. When taking a company private, the exit offer or the price offered to shareholders to buy over their shares must be both fair and reasonable. An independent financial advisor has to be appointed to give an opinion on fairness and reasonableness. Also, the offerer, if it is a major shareholder, and its concert or related parties have to abstain from voting on the voluntary delisting resolution. What you need to know before investing. There are 3 main parts in any good financial plan: save, protect, and invest. For the save component, it is recommended to save at least 20% of your monthly take-home income and to keep an emergency fund of at least 3 to 6 times monthly expenses. For the protect component, the Life Insurance Association of Singapore recommends about 9 to 10 times annual income in life cover, whilst for critical illness cover, the guide is about 4 times annual income. Only after you have sufficient savings and insurance should you then consider starting to invest. The aim of investing is to grow your resources to help you meet your financial goals. However, it is important to bear in mind that all investments carry risk. You should only invest with surplus funds that you do not need in the near term. Before investing, you need to know your financial goals. Are you investing for a new home, or for your child's university fees, or for your own retirement plan. Knowing your financial goals is important, as this will determine your investment objectives and the types of suitable products to attain those goals. Your investment objectives. These can be categorized into 3 broad objectives: growth, income, and security. These will be explained in the later parts of the video. Your investment horizon. This refers to the amount of time you have ahead of you to achieve your investment objectives and reach your financial goals. Younger individuals have plenty of time to ride out volatility in financial markets and earn back losses, so they are said to have a long investment horizon. On the other hand, older individuals are said to have a short investment horizon, as they may have already stopped work and have limited time to attain their financial goals. Your risk profile. It is important to know what is your risk tolerance and risk capacity before investing. For example, if you are risk-averse by nature, you do not want to be invested in products that might offer high returns but come with a lot of risk. Earlier, we said investment objectives can be categorized into growth, income, and security. Reading from left to right, these correspond roughly to our life stages, with growth being the recommended investment objective for young investors. When you're young and have a long working life ahead of you, you can take on more risk and aim for growth, provided, of course, that your risk profile allows you to do so. This means your portfolio can have a greater proportion of equities, with income being appropriate for those who are middle-aged. When you're older, maybe in your 40s, you should consider shifting out of riskier assets like stocks and into those with less risk like bonds, which offer regular income, with security for those who are close to or are in retirement. When you're in the pre-retirement and retirement stages, mid-50s onwards, your focus should be capital preservation. Your investments should be mainly in much safer instruments like high-grade bonds. Getting started. Setting up accounts. Before you start investing, you need to open 2 accounts: CDP account, brokerage account. CDP stands for Central Depository, which acts as a custodian to hold your scriptless securities in Singapore. Brokerage account, where you execute your buy and sell orders. You can open both accounts at the same time at the brokerage house. You then have to choose how you would like to pay for your trades. Shares and other instruments like bonds, exchange-traded funds, and REITs are listed and traded on the Singapore Exchange or SGX. Costs of investing. There are generally 2 types of costs. Transaction costs. These are paid by you directly. This includes the commission and sales charge. Expense ratio. If you are investing in a fund, then you also need to look at the expense ratio, which will include all fees that are charged to the fund. This will include management, trustee, and custodian fees. Strategies when investing in shares. There are generally 2 approaches or strategies when it comes to stock investing: passive investing, active investing. Passive investing is also known as the buy and hold strategy. You believe that the market is efficient and the easiest way to invest is simply buy a fund that tracks the index that represents the market or sector that you wish to be invested in. On the other hand, active investing involves a more hands-on approach. You believe that you can outperform the market by selecting growth stocks or value stocks, or choosing between cyclical versus defensive stocks. Passive investors believe that it is not possible to beat the market consistently or identify market inefficiencies regularly. They are then content to simply buy and hold. Most would then opt for exchange-traded funds, that is, funds that track particular indices. Passive investors believe that the market is efficient and so do not aim to outperform the market through active stock selection. Time in the market is more important than timing the market. The passive investor builds wealth gradually over the long term by staying invested and letting compound interest do the work. Most passive investors invest in equity index funds that simply track stock market indices. These can be in the form of unit trusts, which are unlisted, or index ETFs. Note that ETFs will have lower fees and expenses than unit trusts. Active investors believe the market is not efficient and that it is possible to make money by exploiting inefficiencies. This can be done by selecting stocks using tools like fundamental analysis, or by trying to identify themes which might be expected to outperform in the near to medium term, or even by trying to time the market, maybe by using technical analysis. Before you start crunching numbers, though, it's critical to develop an understanding of what the company does, its products and/or services, and the industry in which it operates. Active investors use fundamental analysis to derive a company's value. They plow through financial statements, look at the notes to the accounts, calculate the financial ratios, compare similar companies in the industry, look at economic forecasts and how they will impact the valuations. They also need to look at the non-financial information such as the quality of management, and by conducting SWOT, which is strengths, weaknesses, opportunities and threats analysis. Then they may use technical analysis to decide when to buy and sell. They look at charts and study the trends and use technical indicators. Technical analysis is not covered in fundamentals of share investing. Active strategy, security selection. When selecting stocks, there are two main investment styles: value investing, growth investing. Value investors look for undervalued companies whose share prices are trading below their intrinsic value. For example, those which trade at low price-earnings ratios or offer a high yield. Growth investors look for growth companies with above-average earnings growth potential. For example, small-cap and technology stocks. Active strategy, sector or theme selection. Cyclical industries tend to follow the economic cycle. They do well when the economy is doing well. Examples would be airlines, discretionary goods like home appliances, construction and luxury goods. Defensive industries are those which are needed in all phases of the business or economic cycle. Examples would be food, utilities and healthcare. ESG, environmental, social and governance investing, is growing in prominence. For example, investing in companies that are socially responsible and pursue green policies, gender equality and have strong corporate governance. In the next video, we will look at how to evaluate a company's corporate governance. Here are the key takeaways for this video. Investing in shares can enable investors to beat inflation and receive dividends, but it comes with many risks. You should ensure that you have enough savings and insurance before investing. Active investors believe the market is not efficient and will use various tools like fundamental analysis to try and pick stocks.